My name is Will Stringer, CEO, co-founder of Chisos and Chisos Capital. And Chisos Capital invests directly in people. So it's a bit of an alternative approach to providing capital to the earliest stages of entrepreneurship today. So we really see ourselves as unlocking talent, that day one talent, by providing $15,000 to $50,000 of capital to entrepreneurs that are starting their businesses. So our thesis was that a new capital solution was needed. We have the Great Resignation going on. We have the nature of work changing. Entrepreneurship is on the rise. People are rethinking their careers and rethinking what it is that they want to do for a living, which is leading to more entrepreneurs, more businesses being created. The traditional way to start a business is either you go get a loan from a bank, or you go raise capital from a VC or angels, or you're lucky enough to have some personal wealth or some friends and family wealth. Those sources of capital are actually fairly rare. So less than 5% of businesses ever receive angel or VC funding, less than 18% of businesses receive funding from banks. So there's a large number of entrepreneurs that don't have good capital options. That's where we step in. We are providing capital to those entrepreneurs that maybe have a good career track record, but no hard assets or personal wealth saved up. One of the kind of trends that we're seeing and on this page is the future of investing directly in people. And the people in our case happen to be entrepreneurs starting their businesses. So to kind of put it in context, this looks like venture debt at the earliest stage. It feels a little bit like revenue-based financing for individuals. For us, it's called a convertible income share agreement. And it's really two pieces. So one is the income share agreement, which is an instrument that has been used in the education space for about 5 or 6 years now. A little over, I think, $500 million worth of originations have occurred. We're using that instrument with entrepreneurs, so taking it out of the education space. So when we make an investment, we underwrite the entrepreneur, and when we push go, we sign an income share agreement with the individual, and their business that they've started or will be starting issues us a SAFE, anywhere between 1% and 5% of equity. So we actually have two separate pieces where we can earn a return that also interact with each other. So one example that we give is, what if we could have bet on Jeff's potential? He was a VP at a hedge fund, started an e-commerce business, had good earning potential individually as a hedge fund VP. If we had made a $50,000 investment in him when he started his e-commerce business, really two outcomes could have occurred. One, where Amazon succeeds, we are an equity holder. We also get paid back through Jeff's income. So we have two ways that we earn money. On the downside, say Amazon would have failed, that equity would have gone to zero, but Jeff presumably would have gone on to have some career success, earn a healthy income, and repay us through the income share agreement. So again, really two ways that we can make money. Now, we realize that these entrepreneurs are very green often. They often need more than just capital. And so we're not recreating the wheel and creating our own accelerator or incubator, but we are partnering with those accelerators and incubators, funneling entrepreneurs into the appropriate programs, and then also trying to surround them with best practices, perks, resources, mentors, advisors, anything that can really increase the odds of their success. So it's capital plus resources to help them start and grow their business. This instrument was designed with both investors and founders in mind. Like I said, there's kind of two ways to earn a return here. One is through the equity, which is uncapped. We're an equity holder right there with any other investor. With the income share agreement, there is cash yield. So on a monthly basis, if the entrepreneur is earning over $40,000 in personal income, whether that is from their startup, from a consulting side gig, or from a primary day job, they will pay us back a percentage of that income. So there is cash on this instrument, and that cash gets returned to our investors on a quarterly basis. And then we'll also have a portfolio of 100 to 200 companies, in the next few years, and a portion of those will go on to raise later stage capital. We have pro rata rights, and so those pro rata rights also get passed on to our investors that want to participate. And then on the founder side, we're really the only capital source for pre-traction founders that, let's say, don't have a Stanford or Google pedigree. We can come in pre-revenue, we can come in pre-MVP even, really on the basis of the entrepreneur as an individual, underwriting specifically their future earning potential, given a number of factors that we underwrite. We can move quickly, so we can underwrite and fund, within a week. And our investment terms are flexible. So like I said, unlike traditional credit products where you have interest and principal that's due every single month, no matter what, our payments on the income share agreement are only required when you're earning income over a certain threshold, which is very beneficial for these entrepreneurs that are working full-time on their business and not paying themselves. During that period of time, they don't owe us anything. Some unit economics on what can actually happen with every single one of our investments. So, in an ultimate downside, the ultimate downside is if someone runs off to Costa Rica and we never hear from them again. In the performant downside, founder raises capital from us. There's a mechanism by which they can reduce the repayment cap of the income share agreement to 1x, and then their company fails. In that case, we'll get our principal back over a period of, let's say, 4 to 6 years, and that's it. 1x on that downside. The base case, again, we're investing super early, so many of these companies are going to fail. The base case is we get a 2x back on our income share agreement, and that again is over, let's say, 5 to 8 years on that income share agreement, with cash coming all along the way. Then on the upside, you add on the equity component. We think a small percentage of our companies will actually have an equity exit, and where we're coming in is typically at a $1 to $4 million implied post money valuation. And so a company can have an exit for 10, 20, $50 million, and that's great for us. That's a great outcome because of where we've come in and where we're also earning returns from the income share. So that's also a benefit for us where we can invest in companies that are not necessarily going to be unicorns, and so they're not able to attract that venture capital investment. We've done this. So we had a fund one that we raised earlier this year, fully deployed mid this year into 12 companies. We currently have 5 companies that are being warehoused for our fund two. So we have this portfolio of 17 companies. We are looking to make 100 investments in this coming year. So really looking to scale up this year. When it comes to actually sourcing and underwriting these opportunities, we have to do this at scale because we have small check amounts. Starting with sourcing, there's really 2 ways that we find these opportunities. One is, pretty traditional marketing. We're out there on social, putting out blogs, getting on podcasts, getting the word out. 2 is strategic partnerships. So we're talking with accelerators and incubators and VCs around the United States to say, here's what we do. We invest, day one, friends and family. You're going to see a ton of deal flow that is too early for you or not right for you. Send them over to us. We'll underwrite them, potentially make an investment, and then potentially send them back to you when they are ready for you. That's a pretty easy sell because all of those groups, instead of just saying no and turning them down, they can say, hey, go talk to this capital provider, Chisos, who can potentially write you a check. once they come into our funnel online, they provide us with a number of data points. Some of those data points are on the founder individually. So we're trying to get to a founder score, looking at things like credit, income levels, debt to income ratios, career, technical and domain expertise. We take all of that data and distill it into our founder score, which is about 66% of our weighting on scores. And then the second step is looking at their business. Once they pass that founder score checkmark, we take a look at their business, very high level diligence, trying to understand, are they incorporated? What's their business model? What's their go-to-market strategy? Is this a viable business that has the potential to succeed? Obviously it's super high risk, but we just want to know or have conviction that there is potential for this business to have some growth. So the business score, that's about a third of the scoring combined that gets to our opportunity score. And that's how we stack rank all of the opportunities and efficiently move them through our diligence process and eventually funding once they actually get the green light. So, our team is made up of finance professionals as well as technology professionals. So myself, I started in oil and gas investment banking, worked at a single family office, really across assets, across geographies, public, private, really everything. So I have that background, worked with my business partner, Stephen Grinalds, at a fintech company where I spent about a year. He spent about 5 years building systems, both hardware and software, which is where the combination of our talents really shines on this platform. We have the technology component that helps us source, underwrite, and service these opportunities. And then we also have the finance component to underwrite and construct an attractive financial product here. And then we're supported by marketing specialists, CFO, and capital finance and strategy. The opportunity today is investment in Fund 2. So we are raising a $5 to $10 million vehicle, executing on the same strategy that we ran on Fund 1. This vehicle is targeting 20 to 25% gross IRRs, about 2.8 times MOIC, fund life of 10 years. And it's really structured as a structured credit type fund. So there's no annual management fee. The fee is money goes out the door. We take an origination fee. Money comes back in. We take a servicing fee. And then on the equity piece, we take a percentage of any kind of liquidation that occurs on the equity component. So yeah, again, Chisos Capital. We're pretty easy to find on Twitter, LinkedIn, the internet, and always happy to take questions or have any kind of discussion.
So can you talk about the expected returns that you have and your cost of capital, and also do you take warrants, or how does that work? It's actually a very flexible structure. So can you talk around it?
Sure. Yeah. So the actual structure of the investment, again, is that income share agreement with the individual that stays in place, sticks with the individual, stays in place no matter what happens with the business. And then with the business, we actually get a SAFE. So we get that simple agreement for future equity that will convert into equity upon the next price round of that company, and then we'll participate as an equity holder. Our cost of capital obviously is this equity only funding that we're doing today. So we're raising the fund on an equity only basis. We may look to lever that as our cash flow profile starts to prove itself out. But that fund return profile is, again, 20 to 25% IRRs and 2.5 to 3 times multiple on invested capital.
Can you talk about the size of the marketplace? Venture lending has been around forever, but venture valuations were never this big, right? So even though venture lending is bigger than ever, I don't think that proportionally venture lending has kept up. So can you talk around that and how big the market is and how big you anticipate it getting, et cetera?
Yeah, so the pure venture lending market is, not that big in terms of the actual types of companies that qualify for venture lending. They have to have specific growth profiles, specific cash flow profiles. Oftentimes, they have to be backed by reputable venture capital firms. What we're doing really looks a bit more like individual credit, kind of blended with early stage business loan, with some equity kicker. It really is a new type of instrument that's been designed specifically for this segment of entrepreneurs that is underserved by today's capital markets. I'm going to butcher the numbers a little bit, but I'm pretty sure over 500,000 businesses per quarter were started over the past year. So kind of record business creations. As I mentioned before, less than 5% of those businesses are going to receive funding in the form of angel investment or venture capital. Less than, let's call it 20%, will receive funding from banks, which require a specific 2 to 3 year track record or hard assets. And so there's really this segment of what we think is, at a minimum 10,000 entrepreneurs per year that we can underwrite and potentially invest in that are starting businesses. Now, to look towards the future, entrepreneurs are one segment of individuals that can utilize this type of capital. But entrepreneurs are just one type of, we call them creators. They are creating a business. There's other newer types of creators that are creating their own career path through content creation. So Substack writers, YouTubers, Twitch streamers, really any of these individuals are starting their own business in a way today, and they need capital to get started. And so that's another subsegment of individuals that we'll be looking to fund in the future.
Can you talk about this? So is this a fund one, a fund two?
Yeah, this is fund two. Fund one, again, we raised in January of this year, deployed it in about 6 months. We have 3 equity markups in fund one. So 3 companies that have gone on to raise additional capital from outside investors. We made our first distribution in July of 2021. That was 5% of the fund. This month, we're making our second distribution of 4% of the fund. And we expect anywhere between 5 and 10% of capital to be returned every 6 months as we get payments back on the income share agreement. So again, cash flow plus equity upside here.
And what's the capacity of the strategy today, et cetera?
Yeah, today, capacity, we've really not hit capacity. So it's hard to say on the top end. We think we can make 100 investments this year. We think we can make 250 investments, 250 to 500 investments the following year. We think we'll, potentially cap out somewhere around 4,000 to 5,000 investments a year as we continue to build our automation capabilities and really start to look like a kind of efficient online lender in a way.
Is there any usage of machine learning or AI in your model today, or do you anticipate going in that direction? Or like, how do you measure, the entrepreneur, et cetera? And you mentioned earlier that, a lot of people, if they don't go to Stanford, if they're not out of Y Combinator or Google, it's very difficult for them to raise capital. And so, do you look at that background as well? Does that make it easier for people under that, or do you use totally different, attributes?
Yeah. So, our attributes are really twofold. One, on the entrepreneur, we're taking a whole lot of data on the entrepreneur, but we're really trying to get to their future earning potential. So, what was their previous income? What is their previous career path? What might they do should their business fail? How is this person going to earn an income in the future? And how likely do we think that will be? That's what we're trying to get to when we're looking at their previous income levels, their credit, references and psychographic information, such as grit, hustle, ambition, other traits that make that indicate entrepreneurship, successful entrepreneurship. On the question of machine learning, today we don't have machine learning. We're using fairly standard credit type models when we're underwriting the actual downside or credit risk of the individual. As we gain more and more information about the outcomes of our investments, as we layer in more and more information on the outcomes of other income share agreement investments, whether that's in the education space or call it nursing or trade school or whatever it is, that's when we can start to layer on that machine learning as we have more data and more outcomes to really help us drive our underwriting models and tweak some of those factors.